A very good afternoon to all of you. I, on behalf of Phillip Capital, would like to welcome you all to Phillip Capital webinar. The topic for the day is results review. Before we go on to the presentation, I would just like to brief you about the Phillip Capital corporate profile. Phillip Capital is an integrated financial house with a global presence using information technology and distribution as core competencies in the provision of financial services. We are present in the financial hub of 17 countries, which includes UK, France, US, of course, head office, where our head office is Singapore, Australia, and in India, among others. We were established way back in 1975, though we started our operations as a financial services company, but over the years have grown into a full range of quality and innovative services to retail, high net worth individuals, family offices, corporates, and institutional customers. We have assets under custody or management worldwide to the tune of USD 33 billion and shareholders funds in the excess of 1 billion US dollars. We have over 1 million clients worldwide. We are we are present in different products and services, which includes stockbroking, private equity, debt capital market, fund management, corporate finance, institutional client group, among others. You can trade the world market with us through Phillip Online Electronic Mart System. In America, it includes CME, CBOT, or in Canada, TSX, SGX in Singapore, Hong Kong, Dubai, among others. We also have a Phillip Telebroker, which is a 24-hour automated shares trading service, which complements the Poems internet. We also have a Poems mobile and a Poems Pro Trader. These are our major milestones over the years. For example, in 2010-12, Phillip Capital took over the assets of MF Global India and MF Global Middle East. These are the different awards which we have won. In 2010 and 13, we were awarded the Best Retail Broker Award by Securities Investor Association of Singapore. Phillip Capital India is a part of Phillip Capital Group of Singapore. We have been a dominant part in the Indian securities marketplace in the past decade. Commodities broking arm in India is one of the pioneering service providers for access to local commodity futures. We have worked extensively with institutional clients as well as HNIs and retail across different asset classes. We are client driven, we have market experience, and we believe in trusted relationship. We have a strong presence and knowledge of key financial markets, and we have a proven track record in client servicing. Our local business structure includes equity, commodity, currency, interest rate futures, fixed income, and distribution. These are the different platforms which we provide. Some of the other services includes portfolio management services, margin funding, distribution of different products which includes IPOs, mutual funds among others, loan against shares, securities lending and borrowing, algo trading, and personal loan. Our research inputs include large cap or mid cap fundamental research, daily technical analysis, daily derivative analysis, daily currency futures report, daily interest rate futures report, daily commodity reports. This was an event which we had wherein the Honorable Shri Nitin Gadkari was present in one of the events. These are the different trading platforms which we provide locally and internationally. So with this, we'll go into the topic for the day, which is India results review. Before that, I'll brief you about the speaker, Mr. Naveen Kulkarni. Naveen is the co-head of institutional research. He joined PhillipCapital in March 2008 from Religare Securities, where he worked as a telecom analyst. He brings with him a diverse experience of 6 years in the industry and the capital markets. He worked with Reliance Communication as a zonal head in Delhi. He is an electrical engineering graduate from University of Mumbai and has an MBA from the International Management Institute, New Delhi. He is a certified financial risk manager and a member of Global Association of Risk Professionals. So with this, I hand over to Naveen.
Good afternoon, friends. Thanks, Mrinal. The topic for the day is what has happened in the last quarter, how things are panning out, and what do we see for the future. So, if you look at over the last 7 to 8 years, uh, the challenge for the markets has been the overall earnings growth trajectory. There have been areas which have done well, and there have been areas which have actually floundered to a very large extent. So overall, the market has not given good numbers in the last 4 to 5 years. FY18 was an exceptional year in that aspect where we saw earnings trajectory coming back. One of the things that has been talked about is the base for FY17 because of demonetization and other aspects was a little lower. But FY18 also had the implementation of GST, right? So that was also a disruption. GST, some would say, was a bigger disruption than demonetization. In many aspects, somebody would say demonetization was a bigger disruption. So all these factors put together, what I can still say that one will cut out the other and other will cut out the first one. So net, what we are seeing in FY18 is something which is very heartening to us that the earnings growth momentum has come back. So Q4, if we look at the Nifty Q4 performance, so Nifty is a weighted index. So TCS, which is the most valuable company in India, is not the highest weighted stock in the Nifty. So the highest weighted stock in Nifty is probably at this point in time would be HDFC Bank. So the weightage is based on the free float of these stocks. So that has a bearing on the allocation. So Nifty EPS grew by 24% in Q4 FY18. It does not mean the overall earnings for all the companies put together grew by 24%, but it's because of the Nifty weighings, it grew by 24%. This even includes the negative effect of the banking industry, which reported huge losses and did a lot of write-offs in the quarter. But even then, the Nifty EPS growth was very, very strong. So, and if you see the table on the right hand side, if you can have a look, the EPS growth trend in FY18, this is if you look at all the 4 quarters, Q1 was the impact of demonetization, Q2 improved, Q3 gained further traction, and Q4 again maintained that traction. Q3 was, of course, the base was quite low. Q4 again the growth was very strong. So what I can say is that the numbers on a quarter on quarter basis look fairly strong. Important factor is where did this come from? If I were to look at various Nifty indices, Nifty commodity has been one of the strongest performers. Nifty metals has been a strong performer. Pharma, while the numbers were bad, but still the base was low and the numbers were better. FMCG is one of those sectors which has been delivering phenomenal numbers. And you can see the re-rating that has happened in the last quarter, right? So overall, what you can see is that bank was a problem area, but other than that, if I were to look at it, the earnings growth trajectory has been fairly good. Banks, the interesting part is there is a lot of cleanup that has happened. So that means the earnings growth trajectory for even for the banks is going to improve. How does it stack up against the expectations actually? So we see that 40% of the companies actually beat the expectations, 42% missed, 14% were in line. So bulk of the Nifty companies actually were in line, which is 40 plus 14, or beat the expectations. So majority are actually beating now. Beats came from industrials, telecom on lower base, and even the expectations were lower. Cement, right? The expectations were lower. Apart from that, FMCG and all, there were expectations were higher, but even then they beat the expectations. So I can see a decent mix of sectors where there is beat coming in, and wherever there is a miss, I would say that that has more to do with technical factors like cleanup and other things which actually led to that, and actually stocks have done well after those results. For example, SBI as an example reported a huge loss in this quarter, but the market views it as a cleanup activity, a necessary evil, and now from here on the performance should start improving. So that is what you can even look at the stock performance. It has actually gained traction. So overall, it's a very, very strong performance that we have witnessed in the quarter. Now, what do we look at FY19, FY11 to FY17 as I was suggesting? Nifty EPS grew by just 5% CAGR on a annualized basis. FY19, the base, FY18, the earnings grew by 19%, which is a big, big leap over what has happened in the last 7 years. FY19, the growth expectation is 20%. Is there a chance that the growth might be higher? Very likely it can be higher. Reason being the GDP growth rate is gaining traction. Q4 GDP grew by 7.7%. Whether it stays at 7.7% or not is not the big problem, but the bigger aspect is going to be how it is gaining traction over the previous growth trajectory. So what we are going to see, let's say 7.4 to 7.5% if the GDP were to sustain, which is what the RBI is probably looking at for the next year. And probably the first half of the year might be stronger than the second half. Then we are looking at a very, very strong growth trajectory even for the economy as a whole. So 20% growth trajectory for the Nifty earnings is something which is not very, very difficult to achieve. Because we are looking at 7.5% GDP growth rate, we're looking at another 6% inflation kind of a number. That takes the overall nominal growth rate to 13.5, 14%, which is a very, very large number, right? And what we are looking at is earnings. Earnings will of course be much, much higher considering the capacity utilization of the economy improves and there is an operating leverage which comes into play. So overall, we should see very strong earnings growth trajectory for next year. Even areas like banking should start delivering, and the bellwether should also deliver. IT, which had been sluggish for the last 3 years, is coming into its fold. So earnings are not going to be a challenge in FY19. There will be a lot of political noise and other things, but markets actually are more focused on earnings, and the returns are dictated more by earnings growth trajectory than anything else. If I were to say that all these earning growth is actually factored into the current multiple, maybe not. So FY18, the market delivered a 10% return. I'm talking from April to March, right? Whereas the EPS grew by 19%. So not necessarily the multiple of the market has kept in tandem with the earnings growth. So that means the market is not necessarily capturing the whole improvement in growth trajectory, right? FI18, as I was saying, earnings growth versus the Nifty returns give a decent picture of how things actually have moved. So this is a chart which gives whether the market re-rated, derated. So we've seen this happening over the period, right? So overall, we are comfortable with the valuations where the market is. We are very comfortable with the growth trajectory, right? So this is a good time to start looking at investing. One area could be mid caps have come down quite a bit, so there will of course be quite a few opportunities which will crop up. Needs to be more. I would say that the asset allocation towards equities can improve further from current levels. So from the earnings perspective, the top five performance: Bajaj Finance beat, Sun Pharma, Ultratech beat, but we saw earnings downgrade for these stocks, right? L&T did not see any major revision for earnings. So these are where the top five beat has come in. Top five losers were Axis and SBI. Again, these were where this is where the cleanup has happened. So that is what was expected. Coal and others. Again, there are the factors for there would be some extraneous factors which not necessarily have will have a long term. These are all one time factors, right? So these are the areas where the market has actually seen some bit of disappointment, but actually in real sense it was not a disappointment because a lot of things were actually one time. So upgrades we are seeing, this is an interesting table. So this is where we are seeing upgrades. Lever we have seen a significant upgrade, Hindustan Unilever. Okay. We are seeing Eicher Motors, we are seeing upgrade. Tata Steel we have seen significant upgrade. TCS we have seen significant upgrade. ONGC we have seen upgrade. Tata Steel is an interesting play because there are global factors which are coming into play. Then there is some level of corporate development with ThyssenKrupp. So those are the aspects which are keeping things in play. But I would say that if I were to leave these aspects aside, probably this makes this stock could be a compelling buy over the next 3 months. Downgrades, there are quite a few. So typically the telecom stocks saw further downgrades, which was expected. ICICI 20, there's some bit of upgrade. Near term, there's some bit of downgrade. But it has not been that challenging overall, right? Because a lot of things were already captured into the market expectations. Yeah. So that's about it. Yeah. So some of the ideas that we like at this point in time that I would like you to take through are: in steel, we like Tata Steel and we like Steel Authority of India Limited. Our target price for Steel Authority of India Limited is 130 rupees. The stock has run up in the last few days, but you can always wait for a better entry point or you can buy now. But if you have a reasonably long-term horizon of let's say 1 year, this might be a good stock to add in your portfolio. In mid caps, we like Aarti Industries, we like Orient Electric, we like Bajaj Electricals, we like KEA Industries. In large cap names, Tata Motors could be an interesting buy at current levels. Reason being, the lot of pain. The stock has seen a lot of pain, and from here on, we could start seeing some bit of improvement in positive news flows that can start coming. Bajaj Auto is an interesting play. We're seeing good numbers, healthy numbers, and more importantly, it's a good rural play because of the two-wheeler. Apollo Tyres is another name that we like, so that's another play. If one wants to be really brave and start taking some bit of risk, Idea Cellular with the impending merger can give a near-term upside, but it's a very, very risky play at this point in time. Nonetheless, it can provide a decent beat at current levels. So those are our key ideas, and that's the review for the quarter. So if you have any questions, you can type in the box. I'll try my best to answer these questions.
Uh, if you have any questions, you can type it on the question or the chat text box, which is on the right hand side webinar control panel. At the bottom of that panel is a question or a chat text box.
Okay, so Bharti Infratel, derating is something which is difficult to say for Bharti Infratel because the stock is already derated quite a bit. I won't say derating, but the earnings could come down further because the projection for earnings for next 2 years may not be capturing the complete synergies which Vodafone and Idea will have, right? So once that happens, we might see a huge number of exits of tenancies, and that could have a bearing on on the current stock price. So I don't see a huge downside from these levels, but the stock is unlikely to perform in the near term, is what my understanding is. Mid caps, I would say that have come down quite a bit. There is a lot of, I would say that comfort coming back into the system for mid caps. So that is where I feel there can be some names which one can always look at, likes of Make Money. These are good names, healthy businesses where one can start accumulating, right? So then there are other smaller names like Orient Paper, Orient Electric, KEI Industries. So these are places where I would say that there could be a lot of interest. Uh, some of the recommendations that we have, which I would like to repeat again, one is Aarti Industries. This is a more of a structural compounding growth story. Jubilant Foodworks, we are looking at a phenomenal set of numbers even for this quarter. 24% kind of an SSG growth for this quarter on a 5% base. So Jubilant should deliver super numbers. Some bit might be captured into the price, but I would still believe the stock can do well from the current levels. Tata Motors, our thesis is this, that we see the peak of pain is over. A lot of investments have happened. We should start seeing some bit of traction into the coming into the numbers. The base is benign in terms of the volume numbers, so the volume numbers optically should start looking better. Stock price has corrected quite a bit. It's one of the cheapest stocks in the Nifty basket, so that makes us more comfortable with where the current stock is. P multiples. Historically, what we have seen is that market tends to rally before the election, and even it rallies even after the election. So it might be for a very brief period that it corrects. Otherwise, because of election spending, so on and so forth, agenda, promises, XYZ factors, markets typically tend to rally unless and until we see a very bad correlation coming into play, where market gets convinced that that will happen. I don't see a huge problem. Syntax plastics is something that I don't cover, so I'll have to ask somebody else to send you a more detailed response to this. Wonderla, we don't cover. Bhushan Steel also is something which is not in my purview. Indus merger. Sorry, I missed this question from Rajesh. Indus merger, is it positive? It's not having any impact on the company as of now. Yeah, because there are no synergy benefits which can come in. There is some bit of tax saving that you might have, but other than that, as such, the merger is not having any pronoun benefit. If it would have been a leveraged buyout or something, it would have resulted in savings for it would have resulted in improvement of capital structure for Bharti Infratel. But since that is not happening, Um who will buy out Indus eventually is something which remains a question mark. So Indus merger as of now is not having any impact on this stock. Yeah, I guess that's it. Yeah, just one question which I would like to. Uh, BL, we look at it as a long-term positive, but currently it's dictated more by what is happening in Karnataka. So that is a challenge that is posed, but otherwise, from a current valuation perspective or from the defense contracts perspective, it's a good long-term positive story to own. Yeah, thanks.
Thank you, Naveen. In case you have any other queries, you can definitely get in touch with your relationship manager or the person who has invited you to this webinar. Uh, with this, we are winding up this webinar session. Thank you for attending Phillip Capital India webinar.